Good morning and welcome this morning. There's the bell. It is Trading Futures. My name is Ben Watson and I'm joined by my good friend Michael Fairborn here this morning, 20 plus year veteran of the financial markets. Michael is, and he's going to be there to help answer your questions. Thank you to all of you that are joining us here in the live version this morning. If you're joining us in the recorded version, we are glad to have you here as well. Be a part of the conversation. Of course, that's what Michael is there to help facilitate, is answering your questions. I'm going to try to keep an eye on them as well as we get into this discussion. So a lot of things going on this morning. We've got oil on the move. We've got gold on the move. We've got Bitcoin and Ether on the move as well. Some things going on in that crypto space, as well as a Fed meeting coming up in a little over a week. So we've got some things to talk about, perhaps. So let's get into it. A couple of quick reminders. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not an endorsement or a recommendation or specific advice or anything else. Remember that futures and futures options trading involves substantial risk. It's not suitable for all investors. Make sure that you read and understand the risk disclosure statement for futures and options before trading any futures products or considering any futures strategy. Remember that futures trading is not suitable for all investors. Not all investors will qualify to trade futures, and it takes separate trading authorization. So be aware of that as you consider these strategies. A couple of other things to think about, especially when talking about things like virtual currency derivatives like Bitcoin and Ethereum futures, and hopefully at some point in the future, others as well. Remember that they have unique and significant risks. And one of those is one of the things that we're seeing this morning, and that is cyber attacks. So we will see what that looks like as it plays itself out in these cryptocurrency derivatives. But remember to read the NFA Investor Advisory, the futures on virtual currencies, including Bitcoin, and the CFTC Customer Advisory, understanding the risk of virtual currency trading. Remember that these are digital representations of value that function as a medium of exchange, but they do not have legal tender status. And that becomes a challenge sometimes. So we're going to think about that and talk about that as we get into this discussion. Again, remember, we're going to be using the Thinkorswim desktop software platform, specifically the paper money version this morning. It is not a guarantee of future success out there in the real world, but it is a great learning environment, and it is a good sandbox to play in. Remember, though, that the paper money version does not do certain things that the live trading account may do, including using studies in scans and other things. And remember that the paper money account oftentimes will fill at the midpoint between the bid and the ask, whereas in a live trading account, that fill price may be substantially different. Now, the other thing to think about when we talk about fill prices is this one, and that is that stop orders are not guaranteed in execution. If you create an order that issues a stop market order due to exchange rules based on certain conditions that exist at the time of the activation, the exchange may reject the order completely or substitute an exchange designated limit order for that originally triggered market order based on what they call protection points or a protection range. So keep those things in mind. There are always considerations to think about when trading futures, as there is whenever you're trading any product. So let's do this. Let's pop over to the Thinkorswim desktop software platform and see what's going on. Again, my friend Michael Fairborn out there in the chat helping to answer questions. We're glad to have Michael with us, and I am especially glad to see all of you, including our new folks as well as our usual suspects. So thank you for being here. So somebody asked me the question earlier in the discussion today, hey, have we ever taught anything about specifically swing trading futures contracts? Swing trading implying the idea between, about trading between a level of support and resistance or resistance and support. And I think to a certain extent, we kind of keep that in mind the whole time that we're talking about trading futures, whether we're trading shorter term intraday charts or whether we are trading longer term charts, maybe the 1 year daily chart. We're kind of thinking in the context of those levels of support and resistance. Oftentimes, at least when we're looking at speculating on price movement, as opposed to using a futures contract for a hedging position, we're not typically putting on a trend type trade with the futures contract. So I think though what the original question was entailing was, do we ever look at things that are not just intraday? Do we look at maybe those daily types of charts looking at swing trading moves? And I've got one that's kind of setting itself up in a couple of different ways. And this is the one that I started with. I've already placed this particular trade this morning. And what I'm going to do is I'm going to come in here, I'm going to put on here, I'm going to show our orders on this particular chart. And you can see where my order is. This is /MCL. This is the micro crude oil contract. So to add context to this, crude oil has been kind of touching down and maybe creating this little bit of a double bottom. We look at the longer term chart, the 1 year daily chart, and we can see that double bottom getting created right around that 61.43. And there's this kind of mid-range resistance here. We think about a double bottom being much like a double top, where you see that move down and then it rallies back up and it creates a resistance level by coming back down, creating it doesn't always have to be an equal low. It could be a similar low. It could be a skewed double bottom, but we've got that potential for a double bottom here. So the probability is, in this particular case, especially when we've got a little bit of upward momentum, we've got some upward momentum on the intraday chart as well, that this is going to continue to bounce. No guarantees by any means, but it's going to continue to bounce maybe back towards that resistance. In this case, that resistance right around the 65.75 or so level. That would be a typical swing trade from that perspective. If you were looking at this as a kind of intermediate term swing type trade from a level of support, getting some kind of confirmation, close above the high of the low day, bounce, Kevin Horner rule, whatever you want to use as a means to determine, kind of that entry into a bounce off of a level of support. So this is the level of support. This is the level of resistance. And the swing trade would attempt to capture that move from support to resistance in this particular case. That would be a typical intermediate term swing trade. And the technical analysis perspective would likely be that the trade would take the same length of time to move up as it took to come down, right? So it took, 5 or 10 days here to go down. It took maybe 4 or 5 days to come down from that resistance as well. So the theory would be that it would take about 5 to 10 days to make that move back to the upside. So not an intraday trade, not looking at taking the trade off immediately, within the context of one specific day, like we've done with other trades. But let me show you how I put this particular trade together that I entered before we came into the discussion this morning, just so that it was up and ready to go, so that we could talk through this and we wouldn't miss it. So I started to see, let me do this. I'm going to zoom really quickly. I'm just going to move this to maximizing this particular portion of the grid. This is the 1 year daily chart on the micro crude oil contract. Again, tick size is 0.01, so that means our significant digit is this last one right here in the price count. The tick value, each tick that happens is $1, right? So this is a dollar movement, and each point value. So each move from 63 to 64 or 63 to 62, when that digit changes, that's $100. So you can kind of see how that plays itself out here. Then you take that number times this, and that gives you the notional value of the contract. That's the representation of value that each contract represents, or I don't like to use the word controls, because we have no really control over anything other than our risk once we put this trade on. It's not like we control this. That's just what this notional value of that contract represents. And our initial margin into this contract is $600. It's a percentage of, and again, those initial margins are set by the exchange firms. Those can and do change. Those initial margins and then maintenance margins can change based on a variety of different factors, including potential risk, including volatility, including other factors that may influence those initial and maintenance margins. So now the perspective here on this is a swing trade, meaning that move from the support to resistance or resistance to support would be watching this move that direction a couple of times, right? So it's moved that down and it's moved back up and it's moved back down and now it's starting to bounce. So the ostensible reason for entering this trade, or the trigger that fired off this setup, if you want to think about it from that perspective, was this move above the high of the low day. Now, not quite. It wasn't a close above the high of that low day for those of you that are looking for a hold, but it was a trade above the high of the low day in this particular case. And so we were right there looking for that entry. And the expectation is making that move. Now, could this move also go further? Yes. So we've set a take profit target on this order. And I'm going to shift to the right. In my grid, I'm going to move over to the intraday chart. And you can see where I've put this target at 65.80. That's at that resistance level. So looking at getting out of the trade. So this was my entry when it made that move up here above the high of that low day, or to the high of that low day. It was a trade above the high of the low day, or a trade at the high of the low day in this particular case, that triggered the order in. There was increasing momentum as we were going into that. You can see that coming into that momentum just wasn't getting pushed to the downside here. So looking for that increased momentum and that move. Now it's bled off just a little bit as the market has been starting to get going here, but still some positive momentum. We're still above the zero line. We're still holding this diagonal trend line in terms of momentum. The other thing is I've set a stop, and this is a stop market order. That stop market order down here at 62.67 is not below the swing trade low, which was the support level on that longer term chart. But this is the one potential reason that some traders may use both that intermediate term chart, the 1 year daily chart that we were looking at just before, and an intraday chart as a means to manage the risk in the trade. Because if I were getting into the trade here, which is where we ended up getting into the trade about 63.20 or so, by the time that order filled, I think it was about where we entered the trade. If we had put our stop, let me just pop back to this one. If we had put our stop way down here at 61, like 61.20 or so, right? That exposes us to a fairly large amount of risk. In fact, perhaps more risk than maybe we're willing to take in this intermediate term swing trade. In this particular case, we're looking at taking the trade off quickly if it starts going against us. And that's kind of the idea behind having this stop based on this intraday swing as opposed to the intermediate term swing. So that's a common technique that some traders may use in managing, whether they're trading equities, whether they're trading futures contracts. In managing a shorter and intermediate term swing trade is managing the stop based on a shorter time frame, so that the exit is taken quicker than if it's going against you, than the exit if it's going in the favor of the trade. Because look, if we kind of squeeze this grid down a little bit here, you can see we have to go quite a ways up. Okay, so here's kind of, if I bring that grid, or excuse me, that chart range kind of back down into perspective, you see what our risk and reward is in the trade. Because I know you always ask this question about trades like this, is, in terms of where is our risk in the trade versus our potential reward. So if we were looking at that swing trade on the longer chart, on the daily chart, that's where that support level is, right? We labeled that as S. That's where that support level is. But here in this particular case, this is where you can see where over the course of the last couple of days, this level right here where we've placed our stop, I'm just going to label this STP so that we don't confuse this. That's our stop area. That's where our risk is. Our risk is from where we entered the trade, which was right here, right, down to here. That's the amount of risk that we're willing to take. Visually, I'm calculating kind of what that risk potential is here. Okay. And I'm looking at where that level is that I'm going to look at taking that trade off. Does that guarantee that it's going to get filled at that level? Absolutely not. But what it does by putting a stop at that particular level is it doesn't force me to run this risk all the way back down to that next level of support, when it would seem the logical from a technical analysis perspective, the logical place to maybe take the trade off if it goes against us would be this level of support that's been tested multiple times, assuming once again that swing trading methodology. And then the target to the upside is way up here, right? So that's our potential target here to the upside. So if we were to kind of put this into perspective, this is our potential return. I'm just going to put that as a plus, and this is our potential loss, and I'm going to put that as a minus. So you can see that range in terms of our risk and reward. David asked a great question, really interesting question, right? The question is this: do I consider pre-market bars as any different than those during the normal trading day? And I tell you that is an interesting question, because we think about, David, futures contracts maybe a little bit differently than, say, for instance, an equity, because we know that equities primarily trade during those market hours. Yes, there's some pre-market activity and some post-market activity, and we are very quickly approaching the idea of a 24/5 or maybe even at some point a 24/7 market in individual equities. But one of the benefits that's always kind of been existent with futures is the fact that the futures markets move and trade actively outside regular cash equity market hours. And that is because, the futures market has grown out of commodities and economic products that have to react to things that don't fall between 9:30 and 4 p.m. Eastern time. So to look at pre-market bars as any different than those during the normal trading day, not necessarily with a futures contract. And certainly not one that has some liquidity to it like crude oil, especially when crude oil is going to be reactive to things, especially early on in the morning, that are going to be happening in European and Asian markets, right? So that kind of gets to that understanding of why I'm not necessarily treating these any specifically different than if this were an equity, yes, perhaps, and it would be an issue. But not the fact that this is a futures contract. So that's what we're looking at in this particular trade. And you can kind of see visually where this range is. So if we were to put up here R, right, that corresponds with that R that we put on the original chart, moving towards that resistance, and that's what we're looking for. So one of the psychological aspects of trading that traders oftentimes get caught up in is this mindset of being risk averse when the trade is a winning trade, and loss averse when the trade is a losing trade, meaning we're hesitant to take the trade off quickly when it's going against us because we don't want to book a loss, and that turns into booking a larger loss potentially. And we look potentially at taking trades off quickly when they are going in our favor, as opposed to letting those trades run a little bit. So setting up a trade like this kind of visually, and you could run the numbers too, we could do that, but I like to do it visually too so that we can see that. This suggests, okay, I've got a target, an expected target. Is it a guarantee that the price is going to get up to here? Absolutely not. But it gives me a target to shoot for so that it reduces the temptation to perhaps take this trade-off at a short-term win as opposed to letting it play itself out. And the other side of that coin is putting a stop order on the downside, and at a smaller amount suggests that it may help us to overcome that loss aversion if the trade's going against us. It doesn't guarantee it. I mean, psychology is psychology. And we've got to struggle to overcome that. But if we've got a stop order or an alert or something in place that's going to remind us, look, this is a point at which we had from a technical analysis perspective or whatever, agreed that we were willing to take the trade off, that gives us a point at which we could make a decision and perhaps helps us to overcome that psychological barrier, that challenge, that loss aversion that we get caught up in. And so we've got a mechanism to help us take this off the trade. Not a guarantee by any means. Remember, this order could get rejected. It could gap around it. We could see price movement move through it in a fast-moving market, and it could move through that protection range, and we wouldn't get filled. So attention must be paid. I mean, I say that every week, but it's important, especially when we're talking about intermediate or short-term trades, that attention must be paid to these levels so that you can make a decision, because these are highly leveraged products. You know, I'm saying we don't just say these things. We don't just say these disclosures because our compliance and supervision departments require us to. I mean, there are reasons behind this, and it's not just lip service. So it's important to pay attention to these things. And thank you for letting me be on my soapbox, Nikki and Mindy. I hope you're paying attention to this, because this is there are great reviewers, and we love those guys, and they do a phenomenal job with these. So these are important things to pay attention to. All right, there's our swing trade. And if we take it back, let me just kind of kill my annotations here so that we can take this out, and we'll put this back. And I'm going to put this back on that side-by-side view so that you can see the perspective here. This is the range in which we're looking at, right? So here's that 61.32, here's that 65.79 or 80 up here, and looking for that swing trading move. Now, does that mean that if it gets up to this point and it looks like it's moving with some momentum, that we couldn't take the target order off or adjust that target order off? You can. And again, that's part of paying attention. And Kelly, I think that's a good point, trading the chart and seeing what the chart is doing as opposed to just those P&L numbers, so that you don't get caught up in that idea. All right. A lot of other things are also moving here this morning. // I'm going to look at /MGC. This is the micro gold contract that is moving and has been moving today pretty considerably. You can see the swing move that this has made. It pulled back. When I was looking at initially, it pulled back, and then it was really starting to make that rally here. So there's a couple of things that we could potentially look at doing here. We're starting to see maybe momentum rolling over just a little bit. We could look at fading this upward move. But I tell you what, I mean, given the strength of gold, and I'm going to kind of zoom out here into this longer term chart. This is the 1-year daily chart. This has had some pretty strong upward momentum, and that upward momentum is not on the longer term chart really abating very much. So if we look at the shorter term chart, well, before we do that, let's pop here to our 1-year daily chart. Tick size is 0.1, so this is our significant digit. Tick value is 1, so every time this number changes, the 5 here changes to 4 or to 6, that's going to be a point value change of $10. So the notional value in this contract, $10 times this, is 37,045. Initial margin in this contract, about $1,000 larger than that crude oil contract. It's $16.50 in this particular case. So Steve Gold says, no pullbacks on gold. It's too far to catch it now. All right. So that's the question, isn't it? When a trade has made a move like this in that short term and started to make that move up, we had this little bit of a pullback. We had a kind of a bull flag pullback here. So there's a couple of different ways that we could look at this. We could look at fading this rally a little bit back down to the support level, or we could look to catch maybe the next breakout in this rally. So I think, in the interest of the fact that momentum is still pretty high, and without jumping on board a train that is, or a bus that's kind of moving sideways here, We want some evidence to tell us that the bus is still moving in a northbound direction in terms of getting onto the bus, because this next candle is kind of going sideways. So we could set this up as kind of a breakout trade in this short-term time frame. So what I'm going to do is I'm going to look at, and for all of you Fibonacci fans, I'm going to use Fibonacci's as a means to maybe put this trade together. So we're going to go here. This is the top of our move. That's our resistance level, 3706. And I'm going to come down to here as the bottom. I'm actually going to split the difference here and take that logical level as opposed to going down to that absolute low there. That's our move, 0 to 100. 100% is the top of the move. What that means that I'm looking for now in terms of a target to the upside, if this bus does in fact go to the upside, would be this next extension, that Fibonacci extension, the 161.8 level. And then I could theoretically use this 78.6 or the 61.8 level as a level of support to take the trade off. So given the fact that this has the potential to move to the downside here off of this resistance level, we've had once, twice, 3 times a resistance, and maybe 4 times, I'm going to use the 78.6 level as my stop in this particular case. So here's what we're going to do. We're going to build this trade really quick. Right click, buy custom with OCO bracket. And our buy stop is going to be a buy stop here at 3707.6. So I'm going to make that a stop. Now, buy stop is going to work just like if it's a buy stop market, it's going to work just like we'll make that 0.6. So give it a little bit. That's going to work just like a sell stop market. Okay. Now I'm going to place my target out here. We're going to go to 3722. Where is that Fibonacci? 3721. 3721 is going to be my take it off target. 3721 is going to be the target to the upside. We're going to make that good till canceled, and we're going to make our stop 3702. That's that 78% Fibonacci retracement. 3702, and we'll take the trade off if it goes in that direction, or at least hypothetically take the trade off. So now you see that the price has kind of come back down a little bit. It's 3706. We've got a 3707.6. Stop, wait, don't get into the trade until it gets to that price or better order here. And that's how we're going to put this trade together, looking for that move higher. So we're going to click on confirm and send. We're going to put this in our futures group, read through the order, buy one contract if it goes to 3707.6, get out if it goes to 3721, get out if it goes to 3702. Click on send and fire that order off, and we'll wait for this order to fill. Now it hit it, but it came back down, Thea, because I hadn't entered the order yet. 3707.6, and we just triggered right now into that trade to the upside. And you can see where our limit order is here to take the trade off. So let's kind of line this out once again in terms of this potential move in the short term. And again, guys, remember this is an illustrative example, not any kind of a recommendation. Here's our potential risk in the trade, that distance right there. Potential gain in the trade, if it goes to the upside, is there. So let me just do these again. Plus, minus. If it goes against us, theoretically, we stand to make less or lose less than we stand to make in the trade. So smaller risk than we have potential reward. And in this case, I would probably argue, just visually looking at that's about 2 to 1 reward to potential risk. So Mighty Mouse says, hard to enter it now. Well, it's hard to enter it unless you have some context. And this is what we're trying to do here using Fibonacci's, is simply put some context to this. You can see what's kind of going on, right? MACD's rolling over, but look at this. Price is just going sideways here. And it popped up to take that trade, put that trade on, it's kind of backing off, but momentum's not really backing down here very much. Now, does that mean that that guarantees that this is going to go higher? Absolutely not. But this next candle now starts to take off. We're in the trade, so we're capturing this upward movement. The other thing that we could potentially do, and this trade may happen pretty quickly here in the course of this candle as this price starts to move. The other thing that we could potentially do now that we are in this trade, now that we are in this particular trade, is, Mighty Mouse says unstoppable. Well, hopefully, but not necessarily the case, unfortunately. What we could do potentially in this particular trade is now that we're in the trade and it's moving in the direction that we want it to go, we could grab this stop order and move this stop up to where we entered the trade and now grab this. And what we're going to do is we're going to replace that stop order. We're going to move that stop order to where we got into the trade and just read through this order. Again, remember, pay attention to any alerts that might pop up or anything. And remember, this is not going to guarantee at what price we're going to get out. It's just moving the activation price for this stop. And click on send. Now, with that one simple move, just clicking and dragging that bubble, we've moved our stop up to the price where we got into the trade. And now, if this goes against us and takes us out on the stop, we theoretically haven't lost anything. However, that doesn't mean that we're going to get filled at that price. So this could mean that, if this goes down quickly, because what goes up quickly could also go down quickly. This is by no means a guarantee that this trade is going to be successful because it's starting to fade. But that being said, there's some upward momentum. You can see that MACD is starting to push to the upside once again. So we've got a little bit of momentum moving in that upward direction here. So let's do this. While we're watching that kind of play itself out a little bit, you know what I want to do? I'm going to do this real quick. Let's do this. I'm going to come over here and we're going to restore these cells, and I'm going to move this over. This is one of the cool things that I can do is I can kind of move this over to the right so we can keep an eye on that. We're going to go picture in picture here for just a second. So I'm going to keep that chart on the left-hand side or on the right-hand side here so that we can follow that trade. I'm going to unlink this chart for just a minute, the left-hand side, and we're going to take a look at a couple of other areas, /ES. Let's take a look at what's going on in the S&P 500 futures contract here this morning. You can see that futures are fairly sedate. Not a lot of upward pressure. That CCI kind of staying in that middle range. Not a lot of bullish pressure here yet. And kind of watching that kind of settle there. /NQ. NASDAQ, which was up. And look at that. We got kicked out on our stop. Now, here's what's going to be really frustrating. That's why I kept that picture in picture up there so that we could see that happening. But what would be really frustrating is if that price went up like it did, came down, kicked us out, and then went back up, which it could very easily do. But you notice that would have taken us out, that candle would have taken us out on our initial stop as well. So in this particular case, moving that stop up kept us from taking a larger loss in the trade. And we ended up getting out of the trade at a point just about where we got into the trade. And you can see that now gold making that move to the downside. This is one of the reasons why we manage short-term trades the way that we do. Remember when I said that those words, attention must be paid? I wasn't kidding. You got to pay attention to this stuff. That's why I kept that up and we were watching that. All right, /NQ, kind of neutral today, /RT, let's see, /RTY. Russell kind of moving back down a little bit. Let's take a look at a couple of the other areas here in the market while we watch that gold contract play itself out here. /NQ, BTC. Let's take a look at Bitcoin. And Bitcoin, surprisingly, kind of sitting here not doing much today, despite the challenges on to some of those blockchain transactions that are happening at the moment. ETH, Ether, and again, remember when we talk about these cryptocurrencies, there are special risks associated with this, so be aware of those. So I want you to pay attention to that. But a little bit more volatility here in Ethereum, kind of setting up around this range. And I want to also take a look really quickly at /10Y. And we'll take a look at what is going on with interest rates. So interest rates starting to pop back up to the upside here. So here's the question that I have for all of you. As we're looking at the market kind of sitting here stable, and we're looking at this gold contract kind of waffling back up and down here. Do we look at getting in on a possible bull flag and maybe trading it back up to that resistance level? Or do we, boy, I'll tell you what, I'm kind of the mindset here, if we were to do this, let's bring this back over here, of saying, look, it's breaking the 50% level. This is kind of a weakening bull flag possibility. Look at where momentum is going at the moment. Momentum likely to start to tick to the downside here. So we'll wait. Let's wait on that at this point. But now you see a little bit of the reason why we pay attention to things. Now we've broken the 38.2 retracement level. We're moving towards the 23.6. So we could go short that contract if it breaks this level here, breaks that support level, and trade that to the downside. Let's come back to that. Let's put a pin on that. So fading the rally sometimes is a potential. All right, so what I wanted to do is I wanted to look at interest rates here really quickly. This is the 10-year rate, but I also wanted to look at this one. And I don't know how many of you take a look at /ZQ, but ZQ is the 30-day Fed funds futures rate. This is the Fed funds futures contract that is used to kind of get a sense of what the market is pricing in based on their expectations of what the Federal Reserve is going to do in terms of interest rates. So right now, the Fed funds futures, the 30-day Fed funds futures rate, yeah, big revision to payroll data. Okay, that may be it. The Fed funds futures rate, 95.78. That's the current, what's referred to as the implied rate. How do we figure out what the implied rate is from this? So let's do a little calculation here. I want to show you how we can do this kind of off the back of the napkin here. So if we take our Fed funds futures rate, this 95.78, and we subtract that from 100, 100 minus 95.78. That gives us 4.22. 4.22. 4.22 is what's referred to as, this is the implied target rate. Where is the current implied, or the current target rate? 4.25 to 4.5. So this is slightly below the current rate, the midpoint of that current rate. So what does that tell us? This tells us that the market is pricing in an interest rate cut. And from that perspective, we can do that quick shorthand math to see if there is a prediction up or down in terms of that FOMC meeting. So let's do this. I also have over here on my grid the CME Group FedWatch tool, which many of you use, many of you look at. We've looked at this before. This is a third-party provider of information. And as a third-party provider of information, their opinions and their information is their own. It is not reflective of nor endorsed by Charles Schwab. So let me reset that real quick. This is the tool that many traders, oh, it's not working. Oh, so this is a good reason why it's important to understand how to calculate what the current prediction is if this kind of thing doesn't work, if the Fed funds or the FedWatch tool from CME doesn't work, which it doesn't at the moment, this is not planned, but it's a happy accident. We can come back here and we can say we know that the current rate is 4.25 to 4.5. If we were to take the midpoint of that, 4.22, which is the implied rate, which is this number. So let me line this out. That's this number right here, the current Fed funds futures price, 100 minus whatever this is, okay? So equals the implied rate, which is 4.22. And it's the implied rate for whatever is that duration of this particular contract. So this is the implied rate. I'm going to put IR, implied rate. So we can use this to calculate what the market is expecting. So if the current rate, is at this point 4.25 to 4.5, right? That implied rate is below the midpoint of that 4.25 and 4.5 range. So we're expecting now a decrease or a cut in rates. That's the expectation implied by the Fed funds futures /NQ. So now when your FedWatch tool is down, you know how you can put that trade or put that information together and get that information to help out your projections as to what's going to happen with interest rates. So that's how you can use futures in a whole different way. But one of the ways that the market uses those futures contracts as a means to take that data of what the market is thinking and translate that into actionable data. So again, implied rate suggests that there is an interest rate cut ahead. Now we could go deeper into that numbers. We'll do those We'll do those next week as we get closer to the Fed meeting, so that we can kind of see what that looks like in terms of the probabilities, and we'll see how those probabilities match up with the FedWatch tool. All right, so let's come back over here really quickly. /M. Actually, I'll just link this back up again. So let's just make this pink lilac. We'll move this over to kind of that midpoint, and we can see what's going on here. So bouncing right there at the moment over this 23.6, as we start to see this kind of bouncing and moving. So let's go back over here to our monitor tab. Before we do that, let's go to /MCL and see how that crude oil trade is working in our for us here. Still working in our favor. It's not really, it's kind of moved up and it's moved down as we've been talking here. Momentum's slipping a little bit, which is why we've got that stop in place here. But we're looking for trade back to that 65, 63 range. Let's go to our monitor tab, and here's our gold contract. It didn't lose us very much. That crude oil contract not losing us very much here at the moment, but is still working in our favor at this particular point. All right, so a couple of things, guys. Do me a favor. Give us a follow here on our YouTube page. You can click on that subscribe button down at the bottom of the page, or you can go right here, youtube.com/@TraderTalksWebcast. Click on that subscribe button. It's at no cost to you. It helps you set alerts for new content that comes up. It also helps to bring this content up to the top of your YouTube feed as well as others. And if you want to see where we're going to be next, you can come over here to Schwab Coaching, schwab.com/coaching. And give us a quick follow over on X. Michael posted that up at the top of the chat over on X. I'm at Ben Watson CS. Michael is at Mike Fairborn CS. Interesting stuff, guys. Thanks for being with me here today. This is why this type of stuff is a lot of fun, but you have to take it seriously. You have to pay attention to the risks associated with trading. Have a great day, everybody. We will see you again very soon. My thanks to Michael and our great production team and our great reviewers, and to all of you for being here. We'll talk to you next Tuesday. Take care. Bye-bye.